Let's have a closer look to the bond market. So on the bond market, there is supply of bonds and demand for bonds. Now let's focus on bonds issued by states like the German state or the Italian state. The price of the bond is determined on the bond market. So in German, we talk about the Kurs. However, the yield is something else. Yield in German is Rendite. This is according to this simple formula that the yield equals the nominal interest rate divided by the price of the bond. Having this formula in mind, we could explain what's going on the bond market. Assume now the German state needs money. So what is done? The German state issues bonds on the bond market, Anleihenmarkt. So in 2023, the state needs money to an enormous amount, 539 billion euros. So bonds are issued. And what does that mean for the bond market? If the German state, Bund, issues bonds, that means more bonds are on the market, so the supply of bonds goes up. So we have a bigger supply in bonds that shifts the supply curve to the right for a given demand. And as a consequence, the price of the bond goes down. So the price goes down from P0 to P1. So more issued bonds lead to lower bond prices. According to the formula, lower bond prices mean a higher yield. That's crucial now. So if there are new bonds issued, this reduces the prices and simultaneously increases the yield, because yield and prices are inversely related. Now let's take the interesting case of Italy. If the Italian government wants to issue bonds to finance its debt, then typically you might expect falling prices. But what we observe at the moment is that the demand for a given amount of bonds, so the supply is assumed now to be constant, the demand goes up. So from D0 to D1, because people think that the Italian government will repay its debt. So is a reliable debtor. That means that the price of the bonds goes up from P0 to P1. So what we see is more demand for Italian bonds, because people trust the state that it will pay back its debt. So the price goes up and the yield goes down. And that's exactly what we see at the moment. So we see falling yields going back from 4.8 to 4% due to more demand and increasing prices. And that's a new development, what we see in Italy. That, of course, makes it simpler for the new government to come up with new debts.